Welcome to the world of technical analysis. Whether you are a new investor or just curious about how the markets work, understanding technical analysis can give you powerful insights. By learning these terms, you can start recognizing patterns in price movements and make better informed decisions. Technical analysis terms like moving averages, support and resistance, and RSI provide a window into market trends. This can guide your timing on when to buy or sell. While it might seem complex at first, getting to know these basics can empower you to navigate market fluctuations confidently. Let's dive into the very basics indicators of technical analysis and see how these tools can help you in your investment journey. One of the most basic is the moving average. The moving average is a fundamental tool in technical analysis. It calculates the average price of a security over a specific period, like 10, 50, or 200 days. Moving average smooths out daily fluctuations and gives a clearer picture of a trend. For instance, if a stock's price is generally above its moving average, it could indicate an upward trend, while a price below moving average might suggest a decline. Moving averages help investors spot trends, manage risk, and determine entry or exit points. For beginners, understanding moving averages can make tracking price trends easier and more reliable. Next is moving average convergence divergence. This is a trend-following momentum indicator. It is used to spot changes in the strength, direction, momentum, and duration of a trend. It consists of two moving averages, a shorter and a longer one. These moving averages converge, diverge, or cross each other to signal buy or sell opportunities. When the shorter average crosses above the longer one, it may suggest an uptrend. And when it crosses below, it could indicate a downtrend. This indicator helps traders make decisions based on market momentum and is popular among investors looking for trend shifts. Mastering moving average convergence divergence can help beginners identify key entry and exit points. The relative strength index is a momentum indicator that measures the speed and change of price movements on a scale from 0 to 100. Typically, a reading above 70 indicates that a stock may be overbought and could face a price drop, while a reading below 30 suggests it may be oversold and ripe for a rebound. RSI is a helpful tool for identifying overbought or oversold conditions in a security. It helps traders and investors gauge when to buy or sell. For beginners, understanding RSI can provide insight into price momentum and potential reversals. Next is Bollinger Bands. Bollinger Bands are a type of statistical chart that shows the price and volatility of a security over time. They consist of a moving average line with an upper and lower band based on standard deviation. When the price moves closer to the upper band, it may indicate overbought conditions. And when it moves near the lower band, it could suggest oversold conditions. The bands also expand and contract based on market volatility. This expansion and contraction gives insight into price fluctuations. Bollinger Bands are commonly used to identify high or low price points and spot potential reversal points. For many investors, this indicator is an essential tool for understanding price volatility. Support and resistance are key levels that traders watch closely. Support is a price level where a stock tends to find buying interest, preventing it from falling further, while resistance is a level where selling pressure tends to prevent a stock from rising further. For instance, if a stock hits a support level repeatedly and doesn't fall further, it may indicate a strong support zone. Similarly, resistance levels can signal when a stock might struggle to go higher. Knowing support and resistance levels can help beginners understand price barriers and determine optimal buying and selling points. Fibonacci retracement is a method that uses the Fibonacci sequence to predict potential support and resistance levels. Investors apply these retracement levels, such as 38.2%, 50%, and 61.1%. These levels may experience a reversal or bounce when price reaches there. Traders often look for retracement levels after a significant price move to spot where a trend might reverse or continue. The idea is that markets often pull back or retrace some part of a previous movement before continuing in the original direction. Learning about Fibonacci retracement can help beginners identify potential price turning points and enhance their timing in market entries or exits.